All right, Tom. Here's the crowd.
Nice. So can you hear me now, Mike?
We can hear, yes, we can. It's a little tinty, but better than nothing.
All right. Well, I hope that, so I'm staring at a bar. I hope that means you guys all have good drinks. So I'm curious though, by show of hands, how many of you pay taxes? Let's go ahead and raise your hand. You pay taxes. Can barely see. Okay. And how many of you would rather not pay tax if you could do it legally? Awesome. So thanks, Lynn. Thanks for, technology is great until it isn't. But thanks everybody for being there. It looks like you're having a great time. Very, very casual, very interested. So a little bit about my background before I get into what I want to talk about today. I grew up in Salt Lake City, Utah. I was a good Mormon boy at the time. And so I spent a couple of years in France, learning how to get rejected in French, mostly in Paris. Then I spent another couple of years at the University of Utah to do my undergraduate in accounting, and a couple of years at the University of Texas to do my graduate work in tax. From there, I spent 7 years with Ernst & Young, including 3 years in their national tax office in Washington, D.C. I spent 4 years as the in-house tax advisor for a Fortune 1000 company. And then I started my own firm. I built, bought, sold CPA firms for about 25 years. And while I was doing that, I also taught in the Masters of Tax program at Arizona State University. And I also met a fellow by the name of Robert Kiyosaki, of Rich Dad, Poor Dad fame. And Robert and I, for the last 10 or 15 years, have been traveling around the world, talking, presenting financial education. And one of the things that's been very interesting to me as we've traveled, and it doesn't matter if we've been in literally Bishkek, Kyrgyzstan, or whether we've been in Dallas, Texas, or Santiago, Chile, somebody always comes up to me, always comes up to me and says, Tom, this is great information, only you can't do that here. And the first time was actually in Santiago when Robert actually had me explain how to deduct a Bentley, since the Bentley dealer was our sponsor, and there was a Bentley on the side, to the side of the stage. And I went ahead and did that. And an attorney came up to me at lunch and said, great, Tom, only you can't do that here. So of course I tell Robert this story, and the next morning we get up about to get on stage, and he says, Tom, I want you to tell him how to legally deduct a Bentley in Chile. So I said, okay. So later that day, Robert and I got up and we showed a way to legally deduct a Bentley in Chile. And at the end of the event, the same attorney came up to me and said, Tom, I would never have thought of doing it that way, and it would absolutely work. So while it's hard for some people to believe that you can actually create tax-free wealth and do it in a way that the government both supports and encourages, if just for a few minutes, just if we could suspend disbelief, and I'm going to walk you through why it's so, and it's going to be pretty obvious that it absolutely makes sense. So I'm going to go ahead. They can see my screen, right? If I show my screen. Okay. All right. So for those of you who've read any of Robert Kiyosaki, his first book was Rich Dad, Poor Dad. Second book was called Cash Flow Quadrant. And in Cash Flow Quadrant, he explains that there's really only 4 ways to make any serious money: as an employee, self-employed or specialist, small business, big business, or professional investor. And as we've traveled around the world together, I've discovered that no matter where you are in the world, and it's particularly true in the US here, if you're an employee, you make a good salary, you're going to probably pay 40% tax. If you get more education, you become a doctor, lawyer, etc., you'll probably pay upwards of 60% because now you're paying the employee share as well. If you're a big business owner, you're probably paying about 20%. Hence Warren Buffett saying he pays less tax than his personal assistant. And if you're a professional investor, you pay 0. So I've been explaining this to crowds all over the world for the last 15 years. And a few years ago, I decided, I wanted to look at why. Why is this the case? Why do governments do this? Why does it depend on how you earn your money Why does your tax rate have such a big, why is your tax rate so impacted by how you earn your money? And I started looking at, well, what does the government want us to do? What does the government want us to do? Now, I've always known that the tax law is basically a series of incentives. It's a series of incentives, and I knew it was to do things the government wanted, but how do you classify that between these four categories, which I think is the easiest way to look at it? And what I discovered and what I wrote about in the Win-Win Wealth Strategy, 7 investments the government will pay you to make, is that if you look at the primary goals of the government, which correspond, by the way, to the primary goals of most charities, what you find is that the government wants to do a few things in particular. First of all, they want to create jobs. They want new jobs created. And those are vastly created by big business. Okay, now small business does too. And small business, by the way, can get the same tax rates as big business so long as they behave like big business. They also want to create technology. Right? They want US technology created, not Chinese or other countries' technology. They want US technology. And then they want food. They want housing. And they want energy. And if you look at these 5, these are the 5 primary goals of any government. Now, there are 2 others. One would be what I would call security, and that is where insurance comes in. And the other is retirement. And that's where your 401k comes in. And those, folks, are really the 7 investments the government will pay you to make. And I actually run through numbers. So for example, take business. And the government so much wants you to create a business that it will literally pay you to start a business. In other words, the cost of starting the business is frequently less than the tax benefits from starting the same business when you started in your home. And I actually run through those numbers in the Win-Win Wealth Strategy. Why would they want to do that? Of course, again, what they're trying to do is saying, look, if you have a job for yourself, that's an employee. That's a job for yourself. Great. No tax benefits. You're welcome to do that. The government's happy for you to have a job, and they're happy. And then you just say, great, I'm just going to pay my tax. As Robert would say, when we become a tax mule, we shoulder the burden of the heavy taxes. And that's what happens in the E and sometimes in the S. Now, what happens in the small business quadrant or the specialist quadrant is that people get caught up in earning money and not how much money they take home. And so what they do is they try to take shortcuts. So over here on the left side, we have a lot of people that would really focus on these 3 words, do it yourself, because they want to keep their expenses down. But if you look over to the other side of the quadrant, you'll see that these people are very focused on teams, investment teams. I know you've got family offices there. You've got, a lot of team members on the investment side and big business side. Small business also stands for self. You're self-employed. You just own your job. You go from having a job to owning a job, and that's it. And while the government's okay with that, you very well could pay very high taxes as a result. On the other hand, if you do what the government wants done and you do it unselfishly, and I'm going to really emphasize that, because if you look at this, if you have a job for yourself, you pay high taxes. If you create jobs for other people, you pay less tax. If you have a house for yourself, you get a small deduction. But if you create housing for other people, you get a much bigger deduction. If you produce your own solar energy, so let me give you an example. Let's take solar tax credits. Okay, so right now we have this new, I'm going to take a picture of this in case we have to come back to it. We have this big new bill called the Inflation, I'm just going to call it the Inflation Act because I think it's the Inflation Enhancement Act, not the Inflation Reduction Act. And we have solar and this has been expanded. And so here's how it works. So if you're an individual, so if you do personal solar, call it personal solar, you get a 30% tax credit. That's pretty great. So on a $50,000 set of solar panels, you get a tax credit, dollars back in your pocket of $15,000. But what if you do solar for other people? So you either do rental, solar on your rental property, or you do solar on your business property. Not only do you get the 30% tax credit, but in addition, plus you get an 85% deduction. So people are always telling me solar doesn't make any sense. Well, it doesn't if you consider, if you think you're paying 100%, the numbers aren't there. But what if you were only paying 35%? Well, if you're in a 40% tax bracket and you get a 30% credit and an 85% deduction, guess what? You're only paying 35% of the cost. So that means, and I know I'm going fast here, so you're gonna, you got to pay close attention. But if you get, let's say you get a 7% return, okay, let's say you put in $100,000 on your business property, and it saves you $7,000 in energy every year. Okay, that's a 7% return. But if you only put down a third, you're going to multiply that by 3 because you've only put down a third of the cost. So your real return is 21%. Now, I don't know about you, but a 21% return on something that is pretty low risk. I mean, for example, you're in Arizona, Texas, California, you know it's going to be sunny 300 days a year. It's always sunny 300 days a year, at least. So you know that that solar is going to pay off. The challenge that most people have is they're focused on this number right here. They're not focused on this number over here. So when you look at your taxes and you go, wait a minute, if I do things the government wants done, which will serve other people. So how does rental and business? Well, it's rental solar, meaning you're putting solar on for your tenants. Now they're going to pay you for that in rent, but you're doing it for them. You're creating solar for other people. Business, you're creating solar for all your employees to operate. So you're doing solar not just for yourself, you're doing solar for several people. So the more we do that affects other people, whether it's create jobs, create technology, create housing, create energy, or agriculture, I'll tell you just a little hint. Agriculture, as you'll find in the Win-Win Wealth strategy, is the #1 tax incentive in the world, in all countries. The #1 tax incentive is for food production. Well, it makes sense. That's #1 critical is food production. #2 is housing. #3 is energy. So of course, those 3 things are things the government wants done. Well, here's what happened. So a little history here, just a little bit here. Back in the 1960s, President Kennedy had heard that President Eisenhower had done a little bit with tax credits. And we were having a severe downturn in the manufacturing economy after World War II. This is in the 60s now. So the 50s were a big boom in the manufacturing, and the 60s there started to be a downturn. So he said, well, what if we had a credit? What if we had a 10% tax credit? He called it the investment tax credit. What would be the effect of that investment tax credit on manufacturers? Would they build more equipment? Would they buy more equipment? Sure enough, they did. Fast forward to 1981. Now, there were plenty of tax benefits between 1960s and 1981. But fast forward to Ronald Reagan. So Ronald Reagan inherited high inflation and a stagnant economy called stagflation, much similar to what we have today, but the stag part of the inflation was even more, right? We had very high unemployment and very high inflation at the same time. So while Paul Volcker, who is celebrated for reducing the inflation, was working on the supply side, I'm sorry, the demand side. So he was bringing down, raising interest rates as high as 18, 21%. That was to reduce the demand for goods and services. At the same time, Ronald Reagan said, well, wait a minute though, we need the economy to get going at the same time. So what he did in 1981, 1982, 1984, and 1986, count them 4 times in 5 years, he instigated legislation that would stimulate investment through tax benefits. In 1981, it was real estate. 1986, inflation was conquered. So he said, let's do it for everybody. Let's just bring the tax rates down. We had 2 tax rates. We had 2 flat tax rates. Let's bring the tax rates down for everybody. But by then, it was okay to stimulate demand because the inflation was over. But in 1981, he couldn't stimulate demand. What he needed to do was stimulate investment. That's the supply side. You've heard supply side economics. That's what that's talking about. Well, we've had 40 years of significant progress since then, as largely as a result of that combination of tax reduction. And of course, Volcker had to get the demand side under control. But if it had not been for the tax benefits that created the investment, in other words, increased the supply, then we might never have come out of it. So it was a combination of the two, and people tend to remember Volcker and tend to forget Reagan. So the point of this is that the tax law, when it comes down to it, there's 6,000 pages of tax law. There's one line that says all income's taxable unless we say it isn't. There's another line that says nothing's deductible unless we say it is. There's about 29 pages of charts and tables to tell us how much tax to pay. But the rest of that 5,970 some odd pages is a roadmap, a guide to reducing your taxes. Well, a lot of people are concerned. Well, wait a minute, I need to pay my taxes. That's the patriotic thing to do. There's a huge movement to increase taxes. I cannot fathom that movement, but there is, because somehow they think if we tax the rich, it'll solve all our problems. Well, in fact, what we don't want to do is tax investment, because if we tax investment, we slow down the supply side. If we stimulate demand at the same time, we're really in trouble. So what's going on right now is the Federal Reserve is increasing interest rates to slow demand. And then at the same time, the administration, love them or hate them, are giving money to people who spend it. Okay. Rather than focus on investment, they're focused on cheap calories, like giving a candy bar to a child to take care of their hunger. So my point is that, look, this is not a bad thing. You want to reduce your tax, the best way to do it is to do things that are good for the other people, things the government wants done. And here's what will happen. If you notice that all of those things build wealth, okay? They don't create huge amounts of income, but they do build wealth. So you want to write this down. The more money I earn, the more tax I pay. The more wealth I build, the less tax I pay. And that's why I wrote Tax-Free Wealth, which is my first bestseller. And that's why I wrote the Win-Win Wealth Strategy. These are 7 investments the government absolutely will pay you to make. And what we've done is we've actually put together a guide for all of you. And I'm going to just share this real quick and see if I can get to the right screen here. Now I'm going to share this screen, and then I'm going to share this right here. So you should, there we go. You should see that now. And this is just so that you've got a simple guide it's free. So just go ahead and you can scan it. You can go to wealthability.com, wherever you want. We do have a network of 60 CPA firms around the country. If you need a better CPA, or if you have a great CPA and you go, they just need to learn more, send them to us too. We're happy to help any way we can, because our goal, our mission is to help people do more good, and at the same time, pay less tax and build more wealth. Thanks, Lynn. Thanks, Mike.
Oh, thank you. Thank you, Tom. There you go. That was fantastic. Thank you so much for sharing your knowledge and your wisdom. We really appreciate it. And there'll be some follow-up for you later. So thank you again. Really
Absolutely.
appreciate it.
Absolutely. Thanks for having me, and thanks for working through the technology. All good.
Yeah.
Thank you. Bye-bye.
Thanks so much.